For decades, the US dollar and long-dated treasuries were the world's default safe assets. When uncertainty rose, capital flowed into them automatically. That assumption is now weakening. The dollar is not collapsing, but the structural forces that supported it are eroding, and investors need to adjust their thinking. The Japan carry trade is fading. One of the quiet pillars of dollar strength has been the Japan carry trade, borrowing cheaply in yen and investing in higher-yielding US assets. As Japanese yields rise, that cheap funding disappears and capital starts flowing back home. This removes a steady source of demand for US assets and tightens global liquidity. This is not a short-term trade unwind. It is a structural shift. Rising yields everywhere signal stress. Rising US yields used to signal confidence. Today, yields are rising everywhere in the US, Japan, Europe, and beyond. That is not strength. It is a sign that governments are competing for capital and investors are demanding higher returns to hold sovereign debt. When yields rise together, bonds stop acting like safe havens and start behaving like risk assets. Trust in the dollar has weakened. The dollar's true power has always been trust. Sanctions, asset freezes, and the politicization of finance have damaged that trust. The response has been gradual but clear: reserve diversification, rising gold purchases, and reduced reliance on dollar assets. This is not a revolt, it's a slow exit, which is often more destabilizing over time. Even allies are reducing Treasury exposure. It's not just rivals. US allies are also selling or trimming Treasury holdings, largely to fund domestic priorities. As foreign demand weakens while US debt issuance grows, yields must rise to clear the market. That shift puts pressure directly on the dollar and the bond market, while long-dated Treasuries are vulnerable. All of these forces converge on long-duration US Treasuries. They are highly sensitive to rising yields, heavy issuance, and fading foreign demand. In a world where the cost of capital is resetting higher, long-dated bonds no longer provide safety. They carry duration risk. This doesn't mean abandoning bonds entirely. It does mean being cautious about locking money into long maturities when the dollar's dominance is no longer unquestioned. Bottom line: the US dollar is not in crisis, but it is under pressure from multiple directions at once. As global funding conditions change, investors should rethink old assumptions, especially the idea that long-dated treasuries are always the safest place to be.